Welcome back. This is episode 190. In this week's episode, I'm joined by my friend and fellow financial advisor, Shaun Jones. Shaun is the president of Jones Fiduciary Wealth Management, located in Rhode Island. It has over 20 years of experience working as a financial advisor. He's also the author of the best-selling investing book, Unbrainwashed Investing. And today we're going to discuss the often overlooked benefits of investing for retirement through a brokerage account. But before we get into that, just as a reminder, if you are serious about getting a plan in place for retirement, consider signing up for my in-person or online retirement planning course, Retirement Readiness Review. And you can learn more by going to retirewithryan.com and clicking on courses. So welcome, Shaun.
Hey, Ryan, how are you?
I'm great. I'm glad we're able to do this. We've been talking about recording some of our conversations, and glad we have an opportunity to do that.
Yeah, we'll keep it clean, I guess, as far as
Yes, this doesn't
complaining
have
about the industry.
an explicit rating on my show at this point. So
I don't mean it that way. Just keeping it clean about the industry and all of our frustrations about it.
Oh, sure, yes. Yeah, so as I mentioned, when a lot of people think about investing, saving for retirement, they're probably thinking about saving and investing through their 401k. But a great alternative to that is just a plain old taxable brokerage account. So, would you agree with that? Do you think could be some benefits with that?
Yeah, I mean, you can only put so much into your retirement accounts by law. And so if you're not just going to stuff it under your mattress, first of all, a brokerage account is pretty much the next best place to put it. And there's a lot of benefits to it. You actually having money in a non-qualified account, I find, gives you more flexibility tax-wise and just more flexibility in general. So, yeah, I think, I don't know what percentage it is exactly, but it's over 90% of my clients also have brokerage accounts.
For sure, yeah. You've got the limit to the 401k. This year it's $30,500. If you're self-employed, you could put more in through a profit-sharing plan, but there is limits there, and then also flexibility, right? You can withdraw the money at any time. You don't have to wait till the magic age of 59 and a half, right, to tap into your retirement funds.
Yes, it's the flexibility is there, and also I find the ability to have multiple brokerage accounts and kind of setting up each account for different earmarks also helps with the, clients like to visualize it. They like to compartmentalize things, and so I found there's just so many things you can do with a brokerage account that it's obviously harder to do with a retirement account, but it's a very useful tool altogether.
Yeah, what do you mean about like compartmentalizing or having different accounts? Tell me more about that.
So it can be different for each client. I guess one simple, thing is there is a slightly different strategy that we run. But think about it as simple as some clients might like to hold equities in one account and bonds in another. I mean, there's no real reason to do that in terms of strategy. You can put them in the same account, but I have had clients just want to kind of understand how that performance relates to each other. And that makes it a little harder to administer as the advisor. But so that's one example. Another example is just, one brokerage account has check writing ability and, and debit cards. And so rather than put that in with all the trading and making it harder to administer, or just kind of, you don't want to be running the registry all the time or worrying about what's in there. Schwab and TD Bank and these other banks or these other brokerage firms, they have pretty good money market options. I think they're around 5.25% right now. So it's a place where you can leave money that you might be spending throughout the year. And you can shove money in there for clients that are retired, and they can manage their cash that way instead of having it sit in their checking account and, make nothing or having to roll over CDs. So it's a nice tool for them to be able to manage their cash flow if you can separate that off. So yeah, the reasons would be endless to have a couple few different accounts. I think I have 3 myself, personally.
Okay. Yeah. No, you're right. I
Um,
mean, that's something I've been preaching throughout probably the last year and a half, telling people, hey, get your money out of your bank. They are not going to pay you interest ever. And a great solution is a brokerage account because, like you mentioned, Charles Schwab's highest yielding money market, I think, is SWVXX is paying like 5.25%, and there's other options too.
And I think it's, if you put over $1 million in there, I think it's I don't know. It's over 5.5, I think.
Okay.
But
Yeah.
I mean, I don't have any clients. Maybe I do have one client who's got it in there waiting to pay a tax bill or something. But most people were successful at convincing them not to keep that much money in cash. But the other thing I was going to mention is, it is a challenge to get people to feel more comfortable having less money in their bank. So for new clients especially, they've had a certain amount in their bank. Maybe it's $250,000 for some people, when really it's never been below 220. And so it'd be much better for them to just keep 50 in there and put the rest in this money market. And I think having that, having the debit cards and the check on that one account helps them feel more comfortable and confident about that money being accessible to them. I mean, not to mention the fact, that we can send them money within a day.
That's right. They can do it. That's probably because I used to use TD Ameritrade. Now I'm just using Schwab, and the money link feature, clients can do that themselves. They can add money to their account. They can take money out of that brokerage account.
That's right.
Whereas with TD, we had to do it for them, which was fine. I mean, but it's just one less step that they want access. Hey, they can pull it right out and put it over in their checking, or they can get checking.
You get some clients that you get some clients that, it's 2 a.m. and they like being able to have the control of it. Some clients just want to send you an email and have you take care of it like a concierge. And either one's great.
Yeah.
So it's just so flexible, and it allows for not just the investment strategies, but also the overall sort of cash management and portfolio management strategies to be endless, really.
Sure. So yeah, let's talk about taxation of a brokerage account, right? I mean, that could be one of the biggest drawbacks, I guess, because gains, interest, dividends that you receive in that account are taxable, whereas in a retirement account, they would be tax deferred. But you can also set that up where the type of investments you own to try to minimize the tax, right, in your brokerage account.
Right. Yeah. I mean, I think if you do it right, and I know that you do, having that brokerage account is actually going to reduce your average effective tax rate in retirement. And there's no such thing. First of all, there's no such thing as a permanent tax law. There are laws that are admittedly temporary and they sunset. We have laws right now that sunset 2025. And then there are so-called permanent tax laws, which are really just tax laws that will change once they vote on it. So permanent just means they have to vote to change. It doesn't mean it'll stay the same. So anyway, it just gives you the flexibility to pull different strings based on your tax scenario. And what a lot of people don't realize before retiring is that you have a lot of control over your taxable income between the years that you retire and the years that you start required minimum distributions. That's really, in my opinion, that's where 90% of all the tax planning happens for clients. And, obviously there's stuff you can do, like own certain types of real estate in there. I mean, there's lots of stuff you can do. It's honestly, there's so many things you can do. But I think if it's done right, it actually reduces your effective tax rate. And when you think about what that means you're reducing your effective tax rate on your retirement plan as well. So if all that money's stuck in your retirement plan and that's the only place you can go to get it, then you're just stuck. Whenever you're always going to be arm wrestling your effective tax rate every time you want to get money. And it's not going to feel good either.
That's right. I mean, it's a great thing that you've built up a large IRA, right, 401k, and you've done the right thing, save the money. But the negative is that every dollar that comes out is taxable as ordinary income. So especially when you start adding that to Social Security later on in retirement. That could push you into, higher tax bracket than you might want to be in.
Yeah. Unfortunately, we don't own the whole balance in our retirement plans. And that's, a lot of people get really caught up on seeing what that total balance is, and no one ever thinks about how much of that they actually own. That whole balance is definitely not yours.
That's true. That's one interesting way to look at it, right? The
you
IRS
don't own
has a
that whole
claim.
thing.
They have a lien on your account, essentially.
Yeah, and that's kind of one of the worst things about it. You have no idea actually how much you own, or how much you're going to end up owning. Sure. I mean, first of all, what years are you going to pull it out? But second of all, how are the tax laws going to change by then?
Yeah.
So anyway.
So let's talk about just one strategy, you could do in your taxable brokerage account. And would you agree that if you tried to keep your turnover down and hold more stocks or stock ETFs or index funds in there, that would help you in your brokerage account?
Yes. We've had enough conversations where I know we agree that, the tendency towards index funds and passive investing is going to keep your turnover low, going to keep your taxes low. I mean, a lot of people don't realize the turnover. A lot of people are surprised to know that the turnover on those indexes is not zero.
Yeah.
They think that you have to sell it for it to kick out taxes, which isn't true. But compared to any other option, it's a very tax efficient way to hold those brokerage investments.
Yeah, so like an example is that if you own like a S&P 500 index fund and you're just continually buying it, right, dollar cost averaging into it, on a yearly basis, you're just paying tax on the dividends that fund kicks out, assuming it doesn't create a capital gain, right? It doesn't spit out a capital gain.
Right, which it will. I mean, it might be low. It's probably 6-7% of the portfolio, but compare that to, say, a mutual fund, it's going to maybe be up to 30 or higher, depending on the type. Yeah.
So yeah, if you're not selling that fund, then you're not creating a capital gain. And then what I advocate my clients to do is then try to wait till they're in retirement to sell that fund, especially if they don't have a lot of other income that year, and they might be able to pay some capital gains rates at 0%. If they can stay in those lower tax brackets.
Yes. I find that almost no one is aware of that 0% capital gains rate. It's pretty, people just aren't used to the government saying, here, take it.
Yeah.
Right. So.
I think they're stealing or something, but
yeah.
Yeah, it's there. And, but if you're taking other money out of your IRA or you're working, you could, that other income, I believe, fills up that 0% bucket first. And then the gains could be pushed out of that into the 15%, which is still good. But if you could pay zero, right, everybody would like that.
Yeah. I don't know if we've talked about the feature in what we call e-money. I don't know what your clients call it. My clients don't even know what it's called. They just have the link. It's like e-wealth manager or whatever. But one of the great things, I know we're both big fans of that. One of the great things about it is the tax information, that if you've got the stuff in there, if you got the data in there coded correctly, you can actually get it to project for you what your average effective tax rate will be in each individual year. Now, it's not, obviously, that depends on how you do it and what you trigger, but it does give you, in my opinion, it gives you a projection of what you will do if you don't make any, I guess, provisions for tax management. And then you can do things like, okay, well, if this software is telling me my effective tax rate is going to be 22% every year after I start taking minimum required distributions, then maybe I should start triggering some of this stuff at 15%, or maybe I should start taking money out of my retirement plan, and putting it into the brokerage plan where we can, control the taxes. And so that's, I know that you're a fan of that. I think that's one of the best features, is it allows for that tax planning, and then the money ends up in the brokerage account. And so now we're back to our conversation about low turnover, and all the rest.
That's right. Yeah. E-money is a great tool. I use Holistic Plan also. It doesn't do the projecting, but we can create scenarios so that we could project out, like, for this year, or what's the client's income look like and where are they probably going to fall tax bracket wise, and decide, like, maybe we should realize a capital gain on the brokerage account because they could pay it at 0% this year, or maybe we should take more out of their IRA. There's lots of different Roth conversions, like all that kind of factors into that.
Yeah, you turned me on to that, and it's been great. It really, not only does it give us the information we need, but also it lays that information out in a way that clients have never seen it.
Yeah.
Actually helps them. I mean, they actually can read their tax return.
Yeah.
And see what it's all about. So, but yeah, I really like that holistic plan.
Yeah.
Thanks for that.
You're welcome. Wish I created it, but the guys that created it are pretty smart, obviously.
Yeah.
So, another benefit, obviously we talked about flexibility, tax minimization, but also we kind of hit on this, but no required minimum distributions, right? Where you said the IRS you don't know how much of your retirement account they own.
That's right.
Yeah. But also there could be, from a tax standpoint, potential savings to your heirs as well, right? Because if you inherit somebody's IRA, what happens with that? Do you get it tax free?
Up to 10 years, I guess.
Well,
No.
true, right?
So
Yeah,
that-
you could kick the tax can down the road.
Right.
But now they're saying you're
yeah,
not
so
supposed to. You're supposed to start, start taking it every year.
Right, because you're just gonna push it all into that and get your, climb up into the tax brackets.
Yeah.
So, yeah, this might be a good time just to mention. Most people don't realize that, for one, the requirement of distributions did increase. You don't have to take those now until age 73, but part of that same law was they also took away the ability to stretch the IRA over the beneficiary's lifetime, and so now you've got to take it out within 10 years, point blank. They don't care if you take it out all in year one. It doesn't matter if it stays more than 10 years. Is it the same 50% penalty?
I think it is, yeah, plus taxes.
Yeah. So if you
Yeah.
right, yeah. So pretty much, if you leave it in there past 10 years, you're not getting much back of whatever's left in there. So yeah, that really just hastens the idea that you want to deal with it. I mean, I kind of like it because it makes clients realize, okay, I've got to deal with these taxes. They're there. It's true. I don't own this whole thing. I'm not just going to keep kicking it down the road and then pass it on. Because there's really nothing good about that in terms of, especially now you have to do it within 10 years. Okay, their tax bracket might be less than yours, but for people that may even have an estate tax scenario, then they're paying estate taxes on top of the actual income taxes. And yeah, it's a great tool, but I would say for the top 5% of income earners, for the top 5% of the people that utilize it best, it ends up being a trap. It ends up being a tax trap. And so,
retirement plan, you're saying, or IRA.
Yeah, the retirement plan itself. So again, this brokerage account is going to give us more control and more options on how to deal with all that.
Yeah, it's hard to pass up a deduction, right? I mean, I'm a fan. I think I tell a lot of my clients take deductions, but there is the problem of potentially, well, there's taxes owed. It's just how much are you going to owe on it? So it's something
Well, there's this thing that I say, and hardly ever say it eloquently, but basically, if your tax plan, and all the CPAs probably want to close their ears, but if your tax plan is paying the least amount of taxes you possibly can pay each and every year, then I guarantee you will not pay the least amount of taxes possible over your lifetime, or over your lifetime and your heirs' lifetime. Now, forget about the fact that paying the least amount of taxes isn't actually the proper goal. The proper goal is having the most after-tax wealth. And people confuse that. They think that the least amount of taxes every year is how you get the most after-tax wealth. It's not. You're just going to get trapped. And so I forget why I even started telling you that, but
I think you were.
But yeah.
You were just saying
you're just
about
gonna get trapped
minimizing your
in there.
taxes. Yeah.
Right. So what I like about the law is that it puts it in your face and makes you realize that, okay, this can't be deferred forever, and let's give some motivation to deal with it.
Yeah, and you can manage the brokerage account with what you own. If you keep your turnover down, if you own, I would say, tax efficient investments, you're going to keep most of your money anyway on a yearly basis. You're not going to pay a lot. And it's just that upfront hit that if you could have saved 30% in taxes by putting it in your 401k, you're not going to get that by putting it in the brokerage account. You're going to have less money going in. But you've got these things we talked about, the flexibility, no required minimum distributions, potential tax savings to your heir, which I want to come back to because currently there's something called a step up in cost basis, right? Where when you die, whatever your assets are worth on the day of your death, that becomes the new cost basis for your heirs. Meaning that, like, if you did this and you had a taxable brokerage account and you own stocks or mutual funds, whatever, and you made a lot of money, and let's say you had $1 million capital gain over your lifetime and you never sold it, you die and your family gets it, they probably won't pay any tax on that because their basis is now what it's worth on when you died, and they could turn around and sell it right away.
Yes. Yep.
And that's how you avoid that potential, the IRS putting their hand into your pocket, right, to grab a piece of your retirement money.
Yeah. So there's two actually fairly mainstream ways now. That's one of them, that step up in basis, and that's where 1031 exchanges become, we're talking about some other things, but you and I both deal with a lot of business owners. They tend to have real estate connected to their business and all that. So that step up in basis can be a huge deal, provided it doesn't require you to buy a piece of property that you're going to regret having. But it's the same thing applies to stocks. And I've been recently digging into the opportunity zone stuff where you also can defer your taxes through that program as well. So there's a few different ways to do it, but you can't do that stuff inside a retirement account.
That's right. There's no step up on a retirement account.
Right.
The way, I always liken it to, like, if you paid tax on the way in, you're not going to pay tax on the way out generally, right? For retirement accounts,
Yep.
Roth IRA. But if you didn't pay tax on the way in, pre-tax 401k or IRA, you and your heirs are going to pay tax when the money comes out.
Right.
Yeah.
Yep. So the bad news is, well, I guess the good news is you can control your taxes much better. That also can be the bad news too, because now you have to make these decisions and do the planning. But if you're not doing it, again, you're going to do it at some point, whether you're going to get to the point where you have to feel the need to do it. And of course your options will be minimized, or you can do it, every year, every couple of years, whatever. But,
yeah. And you've got liquidity too, right? I mean, your brokerage account, if you've been saving this money and all of a sudden there's a great business opportunity, or you want to buy a second house, right, or whatever, your money is accessible to you at any time, right, without any age restriction. So that's nice to know. Hey, I can get at that money whenever I want.
yes, liquidity is definitely king.
Yeah.
Improves the confidence level of, if you can get to the money, then it just helps to lower the bar for entry on any strategy or investment you're trying to make.
Yeah. I mean, I would say if you could do both, that would be ideal, right? It's okay to do some of the pre-tax money, some money in your 401k, but I always say next probably a Roth is good, right? Because that is tax-free, but the Roth is pretty low with what you can put in there. And then a lot of people don't qualify.
Do you mess with the backdoor Roth?
I do, yeah. I have a number of clients that we recommend they do that on a yearly basis.
Yes. It can feel futile because the amounts relative to what you can put in other stuff, but after doing it for a while, I mean, it really adds up. it's just like anything else. It adds up.
Yeah, I wish
It's tax free forever.
for sure. Yeah, I didn't do it for a number of years, but I've been doing it for the last like 4 or 5 years, and it'll be a nice side bucket of money to have, right? A nice tax-free bucket.
Yeah.
I just hope that it doesn't go away because Congress threatened
Right.
to take it away last year or 2 years ago.
Yeah, but you know what? The more the more often they threaten it, the less I believe it's going to happen, because that's been happening for a long time now of them threatening it. But yeah, at my old firm, it was very difficult it was very paperwork intensive and very difficult to actually execute a backdoor Roth. So I'm like you, I didn't do it always. But we've been doing it long enough now where the clients are starting to notice it building up.
Yeah, it's pretty.
So it's great.
It's pretty easy to do at Schwab. It's not that big of a deal. And
Yeah.
the other,
Yeah,
yeah, go ahead.
they're great about it. But yeah, it's not a whole lot. So then again, you're back to the brokerage aspect of it. And to the extreme, actually, there's things like cash balance plans. I've had 2 different clients actually that we were considering something called a cash balance plan, which is not mainstream at all, but it's basically a type of pension that you never intend to take as a pension. You're just going to roll it over, and you can get deductions. I mean, for these clients, they were deductions as high as I think it was $160,000 for one client between everything, and it was like $220 for the other client. But when we started doing the math and figuring out, and figuring out how long it was going to be stuck in there was expenses of it. What we ended up figuring out mathematically was that it actually didn't benefit them that much, if at all, to deduct that amount. So
Because they pay it on the other way. They pay it on the way out.
yeah, because you pay it on the other way, and then the more you deduct it on the front side, especially once you start putting in $200,000 a year, even just the minimum required distributions will cause you to hit the highest tax bracket. So you're deducting it on the front end, and then you're paying the same exact tax bracket on the back end. That doesn't save money. You have to, in order for a deduction into a retirement plan, a lot of people don't realize, in order for a deduction on a retirement plan to actually make sense, you have to assume that the tax bracket, your effective tax rate on the back end, is less than when you put it in.
Sure.
The deferral in that aspect doesn't help at all, like literally not one penny. The assumption there when you do that is that your tax bracket will be lower. But if you stuff all your money into it and you get that balance high enough to where the minimum required distribution is going to kick you into that highest tax bracket already, you're not accomplishing anything. And so that was kind of where we ended up with these clients. And yeah, so there was and I guess what I'm saying is you can the deduction can be too high, because it's not a deduction, it's just a deferral, right?
I mean, if you're going to be in the same
in
tax bracket that you started in, you might want to just pay the tax now, put it in your brokerage account, and then bank on you could have long-term capital gains at a lower rate, right? I mean,
especially if you're closer to retirement than not.
For sure, yeah. Then now I'm going to pay 35% on the back end, when I take it out.
Yeah, which those cash balance plans, as I was just talking about, they are geared so that they are most beneficial to people that are closest to retirement.
Yeah.
So it's kind of like a catch-22.
Yeah.
But it was a learning process because I hadn't been through that in a long time. And in the end, we just decided it was not worth it for those clients.
Sure.
But,
everyone's situation is different.
So guess where they put the money?
In their brokerage account.
That's right.
That's right. Well, awesome. I think this is a good point to stop. Is there anything else you want to mention before we wrap up today, Shaun?
I don't think so. I'm happy to have been on here. I started my own podcast after you, watched you doing yours for a while, and was impressed, and I was proud of you for doing that. And so it's neat that we're able to get on your podcast together.
Well, thank you. What is your podcast? Again,
It is called Unbrainwashed Success, and the general idea of it is, the concept that people work their whole lives, and once it gets close to retirement, they've always envisioned themselves just kind of retiring one day, having a party, and then just sitting on their lawn chair, for the rest of their life and reading a book. And the reality is all types of things happen. They get a little bit of anxiety before retirement because it's hard to get that confidence that you can actually retire.
Yeah.
So that's part of the thing. The closer they get to retirement, I've noticed, the less confident people become that they can retire. And just once that faucet of income goes off, it just makes people nervous, understandably. And then the other thing is that I'm sure you've noticed, once people retire, they have all this time on their hand and they don't like it as much as they thought. And there's something around finding a purpose, and kind of, it's the first time in your adult life you can do whatever you want. And so do you feel like what you're doing day in and day out is worthwhile? And so it's in general, it's about kind of all those feelings and the issues that come up around that whole process. We don't always stick exactly to that, but that's the idea. And then the name Unbrainwashed is just, I named it after my book because
it's a great
couldn't
book.
think of anything else to name it.
You got to stick true to your brand, right? So
yeah, exactly.
Well, yeah, I'll put a link in the show notes, to where people can find your podcast and your book. And what is your website again for anybody listening if they want to go there?
I'll give you the easy one. It is www.investjones.com.
Okay. All right. Awesome. Well, thanks for coming on again, Shaun. And as always, if anyone has a listener question, feel free to go to Retire with Ryan to leave your listener question for a future episode. Have a great week, and I look forward to talking to you next Wednesday.
All right. Thanks, Ryan.
All right. Thank you.